Hey, it's Soleil, and this is episode 123 of the Orange Pill Investor. And today is going to be a short one. I'm going to talk about risk, and it's Mother's Day, so happy Mother's Day out there. So I'm going to keep it short. Really, I'm just going to keep it short because risk is too painful to talk about, and I just want to get it over with. Just kidding. It is. There are some painful moments. I do have a little bit of PTSD from from MicroStrategy just absolutely wrecking my wait, no, I need my main account. Yep, wrecking my IRA, and to a lesser extent my main account. And so let's just go over the main risks for selling covered calls, selling cash secured puts, etc. The risks are the same as buy and hold. So if downside, that is. So if the price of your stock goes to zero, then the only thing that you're going to have left is whatever you sold a covered call for. So just for example, and I actually forgot to sell covered calls in Riot this past Friday. But let's say, for example, my Tesla, because the competition is coming and it's just a car company, all that bull shizzle. But I got these 200 shares of Tesla, trade price 177. They're only worth like 163 right now. But let's say something happened and everyone just decided they don't want electric vehicles anymore, and the price of Tesla goes down to zero. Well, all the share value would go down to zero, but then these I sold 4 covered calls at 175, $460 each. So I'd have $320. So everyone else that bought shares would have lost all their money, and I would have lost all my money but $320. So there's a tiny bit of downside protection, but if you just buy an absolute loser, nothing's going to save you. This strategy is not going to help you. So that's the main loss. And granted, I've never owned a stock that did that poorly, but Tesla got wrecked back here. I had a bunch of leaps in Tesla when it was, wait, that's 300 a share. Wasn't it 400 a share? Okay, I may have mistaken. I thought between the stock splits, I can't remember what the actual top of Tesla was. But riding it all the way back down to 100. Didn't it hit 100? What date is this? 7/23. Oh, I'm only going back a year. No wonder this is kicking my ass. If you haven't noticed, I don't edit videos. I just record and post. Yeah. So anyway, yeah, exactly. This damn thing was up to, why the hell is my scale jacked up? Okay. Let's do this again. And now it went back to 5 years. Okay, so all I can do is go down to 1 day if I want 5 years. All right, that's fine. Now we're cooking with gas. Yes, my memory is not as bad as it could be. So it's $400 a share. I had a bunch of leaps here. And then it was down here at 100. And I kind of misjudged my margin. I was prepared for 50% drawdowns. But when it got below 150, I started getting nervous that I was going to hit a margin call. So you can call it a panic sell or whatever, but it was calculated. Around 120 or 150, I ended up selling like a couple hundred shares or something. 100 shares? However many shares. just to make sure that if this crashed to 75 that I wouldn't hit a margin call and get completely blown up. So everybody has downside risk if you're long, right? And collecting 1% a week is not really going to protect you all that much. And so what happened in my IRA, I had 100 shares of Tesla when it was around 500 a share. So my account was worth about 50 grand. Now I was selling covered calls against it, so I'm collecting like 600 bucks a week, whatever, stacking a few extra shares. The price ripped to 1,000 or whatever the hell it, and then the week after that it was like 2,000. But I never even got to that point because when the price ripped to 1,000, I owed 40 grand, and if I wanted to roll those, and so that was not going to happen. And I ended up getting those shares called away, which is why, if I look at my positions, I have no 100 shares in MicroStrategy left. I got these 13 shares left. So I ended up having to turn to a riskier strategy of buying a leaps, and now that lets me sell covered calls against it. So I can keep doing my strategy, and here I am getting, $600 a week still, but my account is not worth $120,000 in my IRA like it would be if I simply just sat on my hands and wasn't selling covered calls. So as much as I run my mouth about how much money I've made selling covered calls, it's not without upside risk as well. But it's not upside risk in the same way that we think of downside risk. Like downside risk, you can just lose everything. But when you're selling covered calls, it's a defined risk strategy. So the risk that I took was limiting how much money I can make. So that's why my account is up from 50 to 58, but it's not up from 50 to 120. MicroStrategy, well, not almost 120. But over time, I feel like selling covered calls still works. And it's just that I had just barely enough value to even trade MicroStrategy. So it was a little too big. I was a little too big for my britches in the IRA. But this is definitely a risk. It's funny, I had the YouTube comments are always so much, some of them are very kind, but some of them are way more suspicious, I suppose. Maybe because they're all complete strangers and there's no community or a sense of network like on X, but I had one guy saying I was obviously scamming because if I was making as much money as I said, I'd quit my job. And then another guy said that was talking about how leveraged I am, which is absolutely true. This is a margin account and I'm levered to the gills in this. But if we see a big drawdown in this, I have some emergency funds that I can access. So I don't want anybody to think that this is safe to do. This is not safe to do, to be purchasing this many shares. Like with this account value, I should only have 200 shares of MicroStrategy. But if this does go south on me, I've got some emergency funds I can access. So this is not as risky as it looks because I'm not as all in as this appears to be. So definitely don't want to misrepresent that trading in this ratio of buying power to assets is normal or at all safe if you don't have a backup plan. But so the IRA though, there's no margin. So if you get priced out of a stock, you're just priced out. So I've had to go and resort to formulating synthetic stock in order to continue trading this strategy. Now, even if I didn't feel like doing that, that would still be fine. I could just go out here and get 10,000 shares of, well, maybe not 10,000 shares, however many thousands of shares of HUT I could get with 50 grand. That would be fine too. I love MicroStrategy more than any other asset on the stock market, but this strategy doesn't really rely on it. I don't need unlimited upside to make this work. I just take some profits, reinvest those profits, and let that multiply like compound interest. That's all I really need. The price going up is a bonus, but you know what I possibly could have done, and I've been discussing this in DMs with some folks, is if I was just sitting on this MicroStrategy and then waited for the rip to happen and waited for it to go to 1,500 or 2,000, you know, double up, triple up, something like that, and then get aggressive about selling covered calls, then I would have captured all of that upside and then been able to sell some really nice covered calls. So that's an option if you're tentative about this and you don't want to get your shares called away. That's one mitigation strategy. But you don't want to get overconfident because there's always risk. When it ripped to 2,000, I mean, you could sell a covered call against that for 2,200, 2,500, and it could have ripped to 3. So even that's not a guarantee. It's just, you know, it's just something you can do. This isn't an all a one-size-fits-all strategy. So for some people, collecting 1% a week makes sense, like I do. Some people might want to sell at the money. They don't even give a shit about the upside. They just want to collect as much fat premium as they can every week. Whatever floats your boat. But this is what I do, and it's worked out well for me. And I've even said in the past that this strategy isn't a guarantee to beat buy and hold. To me, it's just safer. So if you're trading an asset that can go down, then adding some downside protection is a benefit. But myself and some of my irresponsibly long MicroStrategy holders are so bullish on MicroStrategy that maybe selling covered calls against it over the next 18 months will be the inferior strategy. I don't at all think it would be a losing strategy, but it just may not be the optimal strategy. But it's what I do, and it's what I've been doing. So to a certain extent, I will kind of change my philosophy to try to protect myself as best I can from some of these rip-ups. But it's very difficult for me to abandon it completely. So let's see, we discussed maximum downside risk. However, let's just say Tesla crashed from 170 to 80 though. What would I do then? Because I wouldn't be able to sell a covered call up here at the 170 strikes anymore. It would be down here in like 80 or 90. And these values would not be as big as they are. It would be like 1% of 90, so it would be like 90 cents. It would be like going way up here. It would be these values up here. So, but that's exactly what I would do. So I'm prepared to risk a loss if I screw the pooch and the bottom drops out of my value. That's how I deal with that situation. I might go out to 45-ish days and then pick something that's way out of the money, like a 0.3 delta-ish, and grab something out here just to be able to grab a strike that's closer to my cost basis. If that made me a little nervous, I would potentially do something like that. But to protect myself from the upside rips, I have 313 shares of MicroStrategy. So if this rips to $2,000 again, I would have to sell probably at least 100 of those shares. I could also sell the 13. My cost basis is $12.28. So those 13 would be unlimited profits. So I could make about $8,000 selling those for 20. and I could use that 20 grand to maybe cover the cost of my 1370, 1380, and 1400 strikes getting breached. But that's like, well, if it goes to 2K again, oh boy, it's 60 is like 180 grand I'd have to come up with. So these little 13 shares ain't gonna cut it. I also bought some leaps, and if I check options profit calculator, I could check and see what value these would be if the price doubled. And I'm guessing if the price doubled, these might triple. So that's still not going to cut it. I'd end up getting 100 of these shares called away. And I'm totally fine with that, because then I'll just be selling covered calls at $2 grand a share, and I'll be collecting 1% of that. So for me, that risk is tolerable, and I have a plan for it. If that risk is not tolerable and you don't have a plan for it, and if you got 100 of your shares called away and then you'd cry yourself to sleep, then yeah, do something else. Don't do this. It's never financial advice, but you have to be comfortable with your own risk. And the first step to being comfortable with risk is understanding them. So you got the same downside risk that buy and hold has. You've got some upside risk in that, yes, if your shares get called away, you will make some money, but you will not make all the money. So that's what you have to be prepared for and have a plan for. The only other thing that a stock price can do is just trade sideways, and in that case, nothing happens. You just keep making money. All right, that's it for now. I hope that explains the risks. And to the guy that says post my losses, I've covered them in videos before. Let me go back. How long ago did it rip? Where's that big debit? Am I having a mental block? When the hell did this rip? So where's my 10K credit? Because the 35K debit was right before that one. Now I'm just filling this shit with empty fucking space. When the hell did MicroStrategy rip? So it was 2:15. It was at 7. So between 2:15 and 4:1. Oh, I didn't go back far enough. Son of a bitch. There we go. So, yeah, 3:1 debit. Let's see, sell to open, buy to close. Yep, so this is times 100. So this cost me 24 grand this week, 24 grand here as well, because I had the 720 strike and the 715 strike. So when it breached the 1040s, I ended up having to pay 24 grand on each of these. That's close to 50 grand. But then I got paid. Let's see, sell to close. Yeah. So then I got paid 10 grand here. So those are my losses receipts. my account would probably be at least a third greater than 259 if I had just sat on these shares and didn't have to pay, what, 50 grand to roll. I thought it was 35 one week, but apparently it looks like it was 25 each week. All right. But yeah, so definitely I don't want to make this sound like a get-rich-quick scheme or a strategy with no risk. The risk is real to the upside and the downside. But as far as I can tell, it just kind of averages out over time. And there's going to be some short-term fluctuations either way. But as always, do your own research. Be comfortable with with your level of risk, and always size your positions in a way that you can sleep at night. So if you make a trade and you're just nervous about that trade all the time, it's probably too big. So with that being said, I will leave it there, and be good, y'all.